All right, let's just jump right into it, because there's a really interesting puzzle playing out in the markets right now. It's kind of a story of two very different assets, a real clash between the ancient and the digital. And honestly, it's forcing a lot of people to rethink what the future of money even looks like. What's so wild is that the story the market is telling us today, well, it's not the one anybody expected. So we're going to try and unravel this thing.
So on one hand, you've got gold, the ultimate safe haven asset for literally thousands of years. And it's not just doing okay. It's breaking out to brand new all-time highs. We're seeing central banks around the world just gobbling it up at a pace we haven't seen in our lifetimes. But then there's Bitcoin, the very thing that was supposed to be digital gold, right? The big disruptor for a chaotic world, and it's actually losing ground. It's falling behind.
So that's the big question here, isn't it? What is going on? I mean, if we really are stepping into some new era of financial weirdness, a time when people are losing faith in regular currencies, why is the old-timer, the ancient yellow rock, leading the charge, and why is the new kid on the block getting left in the dust? This isn't just about a price chart, you guys. This might be a clue about a much bigger shift happening just under the surface of the global economy.
Okay, to really wrap our heads around why these two are going in opposite directions, we're going to borrow a little idea from a place you probably wouldn't expect, and that's physics. Just for a second, imagine the market isn't just bulls and bears. Imagine it's being pushed and pulled by two fundamental and sometimes opposite forces. We're going to call them the macro force and the technical force. And trust me, understanding how these two play together is the key to solving this whole gold versus Bitcoin mystery. So first up, let's talk about the macro force. The easiest way to think about this is like gravity. It's the big picture stuff, like Einstein's theory of general relativity. It describes those huge, slow-moving, powerful trends that kind of bend and shape everything over a really long time. We're not talking about daily price swings here. We're talking about massive things like sovereign debt, huge geopolitical changes, things that shift the entire global money game. These are the giant gravitational pulls that set the course for markets over years, maybe even decades.
And then, on a completely different level, you have the technical force. This is kind of like our version of quantum mechanics. It's all about the chaos, the cycles, the seemingly random little movements we see in the short term. In our world, this is where you find the chart patterns, the price cycles, the moving averages, all that stuff. It's that boom and bust rhythm that can sometimes look like it's completely ignoring the big picture story, but it's really just operating on its own weird internal logic.
Okay, so let's start with the big picture. Let's put on our general relativity glasses and look at gold through the lens of that super powerful macro force. Because when you zoom out, wow, the gravitational pull towards gold right now is just immense. It perfectly explains why it's been doing so incredibly well.
Now here's the thing. What you're seeing here, these aren't just opinions. They're just facts. Government debt in the US, when you measure it against the size of the economy, is higher than it's been since we were literally funding World War II. And this is not just an American problem. Around the world, government debt is growing way faster than the economies that are supposed to pay it all back. So what's the reaction from the folks managing the world's money? Well, central banks are buying physical gold at a record-breaking pace. This isn't just a trade, it's a huge long-term shift in how the world's finances work.
And this quote right here just nails the logic behind that whole shift. When the very foundations of the financial system start to look a little shaky, the big money, the institutional money, it doesn't go chasing the hot new tech stock. It runs for safety. It looks for a neutral asset, something that no single government or currency can control. And for, well, thousands of years, that asset has been gold. We're not seeing something new here. We're just watching the next chapter in a very old story.
Okay, so that powerful macro force clearly explains why gold is so strong. But here's where it gets interesting. That exact same force, that search for a neutral, scarce asset, that should be a huge tailwind for Bitcoin, right? I mean, it fits the description perfectly, but it's not. So to understand why, we have to switch lenses. We've got to take off those big picture macro glasses and put on the short-term chaotic goggles of the technical force.
Ever since it was created, Bitcoin has run on this surprisingly predictable 4-year cycle. Let's just walk through it. It tends to spend about 3 years going up, from a bear market bottom to a crazy new peak. That peak has, almost like clockwork, shown up in the last few months of the year after something called the halving. And the halving is just when the reward for creating new Bitcoin gets cut in half, making new supply harder to come by. And what happens right after that big peak? A nasty 1-year bear market. It's a boom and bust pattern that has just repeated itself over and over and over again.
And inside that 1-year bear market, there are these key signposts that people watch for. Let's break it down.
The first big warning sign is when the price falls below its 50-week moving average. That's basically just the trend line over the past year. Once that's gone, a sort of countdown begins, a date with destiny, with a much lower, more fundamental line, the 200-week moving average. You can think of this as like the 4-year baseline for the price. The market almost always seems to come crashing down to this line to wash out all the craziness from the last bull run.
So, if this historical, technical pattern holds true this time around, what does that mean? Well, while each Bitcoin cycle has had slightly smaller drops than the one before it, a 70% fall from the all-time high is a totally plausible target for the bottom of this cycle, just based on what's happened in the past. So, the technical force is basically telling us that Bitcoin's current weakness might have less to do with the big macro story and everything to do with it just being in the regular, predictable, downward part of its own internal cycle.
So here we are. We've got the macro force yelling that hard, neutral assets should be winning, and we have the technical force telling us that Bitcoin is just stuck in its own cyclical downturn. But when you put these two seemingly separate stories together, they point to one single massive thing, something that could define the entire investment world for the next decade, a great capital rotation.
So what the heck is a capital rotation event? It's basically a long period of time, we're talking 5 to 10 years, where what investors want fundamentally changes. They start moving their money away from financial assets, things like stocks and bonds, and they rotate that money into hard assets, real, tangible things you can actually touch, like gold, silver, oil, and other commodities. Now you might be thinking, okay, cool theory, but where's the proof? Well, check this out. This table is basically a dashboard for this very rotation. It's super simple. It just compares how gold is doing against everything else. And look at the results right now. The S&P 500, the tech-heavy NASDAQ, the US dollar, even the money supply and inflation itself, every single one of them is losing to gold. When all of these different things turn red at the same time, it's a really powerful signal that a major rotation isn't just coming, it's already here.
And let's be super clear, this isn't some crazy new thing that's never happened before. We have seen these massive decade-long rotations play out in history. It happened in the 1930s during the Great Depression. It happened again in the 1970s during the Great Inflation, a time when gold went up over 2,000% while the stock market basically went nowhere for an entire decade. And we saw another one after the dot-com bubble popped in the early 2000s. Each time, the story was the same. Hard assets beat financial assets for about 5 to 10 years.
Now, to get through these periods, there is one crucial thing you have to understand, the difference between nominal returns and real returns. It sounds complicated, but it's really simple. Your stock portfolio might go up 10% in dollar terms. That's your nominal gain. You feel great. But if inflation is 11%, your actual purchasing power, your real return, has actually gone down by 1%. During these capital rotations, a lot of things can go up in price, but they often fail to actually make you wealthier in real terms. It's the hard assets that usually do that job.
Okay, let's just pause for a sec. If we accept that we might be in the early stages of one of these rare, decade-long shifts, what does that actually mean for us? How do you even think about investing your money in a world that's so different from the one we've gotten used to for the last 10 years? There's this quote that is just perfect for times like these. It's so easy to feel like a genius when everything is just going up and to the right. But these rotational periods, these bear markets in real terms, they are incredibly messy. They are designed to confuse everybody. You'll get these huge stock market rallies that make the bears look like idiots, and then they'll be followed by sharp crashes that make the bulls look just as silly. The market's main job in these phases is to chew everyone up.
And that leads us to probably the single most important takeaway from all of this. Because these transitions are so chaotic and unpredictable, trying to perfectly time every top and every bottom is just a recipe for disaster. The goal isn't to be a hero. The goal is much simpler and way more important. It is simply to survive it, to get through to the other side with your capital intact.
So what does a survival strategy for a capital rotation even look like? Honestly, it's about getting back to boring, timeless principles. It means diversifying your money so you don't get wiped out if the things that worked for the last decade suddenly stop working. It means systematically investing, dollar cost averaging, especially into those hard assets that are likely to hold their real value. It means reinvesting your dividends, and critically, it means getting rid of debt and holding some cash. Not just for safety, but so you can be ready to pounce on opportunities when other people are forced to sell.
So, as we watch all this capital slosh around the world and the old market rules start to feel like they're breaking, it all comes back to this one final question. In this new world we're entering, what is the true safe haven? Is it the ancient metal? Is it the new digital code? Or Is it something else entirely? Like a simple, prudent, diversified strategy that can just weather whatever storm comes next? The answer to that question is probably going to decide the winners and losers of the next decade.